Hey, welcome back to Harvesting Income. I hope you're all enjoying this season with the Easter and spring. Happy Easter. And today I'm going to talk about two ETFs, XYLD and XYLG. Like we have discussed these funds separately in different videos, but why I'm comparing these two is because XYLD writes options on the entire portfolio. XYLG, the growth fund, writes options on 50% of the portfolio. So let's compare the right all versus right 50% strategy and see which of them is good. Like by the end of this video, you will know which of them is good and the pros and cons. And finally, you can make your own choice. XYLD is the global S&P 500 covered call ETF. XYLG is the global S&P 500 covered call and growth ETF. So the second fund, XYLG, has the growth component within it. I'll explain the difference as we go ahead. As usual, this is not an investment recommendation, and make your own financial analysis and judgment before you make any investment decisions. So these are the pictures of my recent spring trip. Like one of them was to the Sunset Point, you can see on the left, and the other ones are basically the spring photos, basically the cherry blossom and a few places that we captured. So this is how we enjoyed our time in this season, with the blessings of our savings plus a little bit of dividend income. So that's just another thing that we enjoyed this season. After all, you need that money to enjoy your time off with your family, friends, or you want to do your passions or anything that you're enthusiastic about. So with that note, let's move on to the first fund, player one, which is XYLD, Global X S&P 500 covered call ETF. XYLD has been in the market for a long time, more than 10 years. And this has a simple strategy. They seek to write the covered call options on the S&P 500 index. So in simple terms, they buy all the stocks of the S&P 500 index, okay, all the 500 stocks in the same proportion, just a replica of the index, and then they write options on the same portfolio, the right options on the index itself. That generates a layer of income. So that's how the fund functions. So typically speaking, what happens with this fund is this is more income oriented, like more focused on generating income for the investors. And in terms of capital appreciation, they will not be much of capital appreciation, or there may be a little bit of plus minus, but it's not going to be significant because the portfolio caps the upside using the at the money covered calls. So this fund has some advantages in terms of income, some disadvantages in terms of capital appreciation, which may be little or none, or probably you may get a erosion of capital sometimes. That's how covered call funds work. So that's XYLD for you. The second one is XYLG. Um, yeah, it is XYLG, which is stands for growth. So this basically has a covered call and growth component within the fund. The reason why they call it growth is because the fund uses the same strategy like the previous one. They buy the S&P 500 stocks and maintain the same portfolio replica of that. And then what they do is they write calls on 50% of the portfolio. So imagine this, like if you have this portfolio, you have 50% of the portfolio which is written in the calls. Like let's say half of the portfolio. This one doesn't, the left side you see doesn't have any calls. Like this is actually um, the growth portion of the portfolio. Let's call it G. And on the right you have the uh, covered call portfolio. So it's equally divided, like 50% is growth, 50% is covered call. So what happens to the covered call portion? They write covered call on this half of the portfolio. On the other half, the growth portion, there is no covered call, nothing like. So basically the growth portion will grow according to the index performance. So index goes up, it's going to go up. If index goes down, it is going to pull it down. If index is flat, it's going to be flat. So the growth component is linked directly to the index. It just functions like any other index exchange traded fund. For example, you have IVV index fund, or you have SPY index fund, like there's so many. So in this, you are getting the best of both worlds. One is investing in the index, and the other is you have the covered call income. So this is something pretty interesting. Like this fund has been in the market for about 3 years now, and they have been doing pretty well so far. Let's compare and see like both the funds and to get the full picture. Let's compare one by one. There's some of the factors I compared which are very important. Like I'm not going to do a detailed one, but I'm going to give you some of the basic important information that you're looking for. One is expense ratio. XYLD is slightly expensive, 60 basis points. XYLG is 35 basis points. I think the higher expense ratio is because of the quantum or volume of covered calls. XYLD writes more covered calls. XYLG writes lesser amount of covered calls because half of the portfolio functions like an index. So that explains why the fee is less. So if you are concerned about fee, probably XYLG is a better option. But this is just one of the many parameters. In this video, I'm going to just look at two or three parameters. Like if you want to do a detailed analysis, you have to go through various other parameters, look at the portfolio holdings and all that. But in this video, we're going to just briefly go through that so that we can understand the features of each fund to get a quick idea. Like this will give you a quick idea how each of them functions and help you make that decision. And then later on, you can, you know, see which works for you. You can do a further deeper analysis. But from the fee point of view, I think XYLG is more cheaper and it also has the growth potential. So that's the 2 points which I can quickly, capture at this stage. But there are various other factors to consider. The next one would be distribution, and then we would go capital appreciation. So quickly we'll go to the main meat of the topic and find out like what is in it for you for as an investor who's looking at capital appreciation and dividends. So looking at distributions or dividends, XYLD is providing you about 12% per year, and XYLG is giving you about 24.9%, almost 25%. This could be higher, lower. This is as of the last 12 months. I've taken the trailing 12 months dividend data. Um, so if you think this is something not believable, I'm going to show you the data, how I did it, briefly to give you the idea how it works. And you can use the same concept or same formula to calculate distribution yields for any funds that you are considering for your portfolio in future. Okay, let's look at XYLD. Like the trailing 12 months dividend comes to 4.74. Let me use the pointer here. Yeah, XYLD's last 12 months dividend is 4.74, price is 38.67. And if you do the math, dividend yield works out to 12.3%. This is just the dividend yield part of it. We are not talking about the price appreciation. Similarly, you do the same analysis for XYLG. Trading 12 months, dividend 6.71, price 26.96, dividend yield 24.9. And these prices are different. It's not comparable. Each one was launched at a different point of time. So these are not um, comparable apple to apple. But if you compare the dividend yields, yeah, it is. You can compare them and say that XYLG is providing you higher amount of dividend yield. XYLD is providing you little less. However, even XYLD is providing you double-digit dividend yield, which is commendable. Like there's no other bond or any safe asset class which gives you double-digit yields. If you're aware of any safe and sound asset classes which provide you double-digit yields, like 10% or higher, let me know in the comments below. Like I want to look at those funds as well. So if you are aware of anything like that, please share your feedback or your comments below. And one tip I would like to feedback or your comments below. And one tip I would like to give here, which is on the right side, always calculate the yield based on the dividend of last 12 months. So the fund will provide you some number or calculation. Sometimes it would be based on the latest month's dividend multiplied by 12. Let's say the latest month dividend was too high because this month was very volatile. Like recently, we saw that due to the trade war and tariffs, blah blah, the higher volatility in the market led to higher premiums and higher dividend declarations or distributions by the covered call funds, and that led to higher yield. So that's something to look at. Don't go by the quoted yield. You do your own math. So add up all the 12 months, last 12 months dividends, and then you divide it by the stock price or the fund's unit price, and then you get the dividend yield. That's a simple calculation. So this would give you the true picture of any fund. So don't go just by the published dividend yield or what is quoted on the website. Do your own research. And I have shown you the steps in one of the previous videos. You can go back and look into my playlist, or you can look into one of my previous videos. You will get a full idea about it. And this data is coming from the fund website from Global X, and we calculated the dividend yield based on the data. So 24.9% seems to be a little high. I don't know if it's going to be sustainable in future. Probably in future it could drop down, like depending on the volatility, or it can maintain. We never know. Um, so it can drop down. In my view, it could drop down a little bit because once the market stabilizes, the amount of premiums would become less. So this is what we have right now. XYLG seems to be the most attractive, very interesting, and XYLD is not bad, like, but it's giving you a slightly lower amount of dividend. Obviously, it's more income focused. And what I'm surprised is growth fund is providing a higher dividend yield. Like I was expecting XYLG to provide lower amount of dividend yield because previously that was the case when it started initially. So let's dig deeper into why this is happening. Okay, before that, we will look at the capital appreciation before digging into the high dividend yield part of it. XYLD is losing 4% roughly in capital appreciation because were launched at $40.31. Now it's 38.67, so minus 4.1%. And XYLG launched at 30.20. Now it's 26.96. So they lost about 10.7%, almost like 11%. So there is an amount of capital erosion in both the funds, and this is quite high in XYLG. That is concerning. XYLD 4% is not bad. It's okay. It's common for covered call funds to erode a little bit, or sometimes it could appreciate or stay flat. So I don't think the XYLD one is bad, but XYLG's erosion looks a little concerning for me. But let's look at the total return to get the correct picture. Yeah. So there you have it. Like dividend yield for the two funds are 12% and 24.9, and then you have price return 4.1, 10.7. So when you add up the returns, total return comes to 8.2 for XYLD, and for the XYLG growth fund, it's 14.2%. So obviously the growth fund is actually doing pretty well, and they're giving 14% return, which is commendable. Like despite losing the capital appreciation, they're still able to give you a high amount of dividends. And so if you are going someone who is interested in higher yield, again XYLG wins the race. XYLD provides better price returns because the erosion is significantly less. Um, this is we are looking at only 1 year, so things could be a little different when you look at a longer period of time. So don't go by what is being discussed in this slide or in this presentation, because you have to look at different periods like 1 year, 3 year, 5 years. In this video, we don't have the scope for going all the way. So you can always look at the website and decide like what works best for you. But I'm going to give you a quick idea in the next few slides, which will give you an idea how things are in the short or medium term and long term. So if you're looking at total returns, XYLG is the winner, obviously. So my personal preference is to go for XYLG because I like the growth component of it, and because you get a mix of growth plus call writing plus which generates income. So mix of income and growth gives me a better option, and I feel I can sleep well at night with some amount of income and some amount of growth. So I know that my capital is not eroding so much, and even if it's eroding, I still get that growth, and I can reinvest, my money into the fund to lower my cost and also bet on the future growth because you're investing in the basket S&P 500, not individual stocks, and you're not designing your own portfolio. It's the S&P 500 which is being replicated, so no worries there. So overall, I feel XYLG is good in my opinion. Still not, we have not come to the decision point now. We are still looking at various factors. Now, I'm just showing you this premium earned and distribution, which is very important because you want to know how much the fund is earning in terms of premium and how much the fund is able to distribute. So some funds distribute more than they earn. Like there are some weekly, dividend pay distributing ETFs, weekly pay ETFs, and there are a lot of other specialty ETFs which are providing very high yield, and sometimes they distribute more than what they earn. One good thing which I like about global X funds is they don't distribute more than what they make. So the chance of the fund eroding your capital by paying you more than what they make, and then your fund's NAV falls down, that is relatively less. I know that in covered call ETF there will be some NAV erosion or decline. However, that would only happen in some cases for global X funds because they have a policy to retain certain amount of funds out of the premium earned. So in this case, I can see that XYLD, you can see that the premium earned is about sometimes 1.4%, sometimes 1.52 and all that. So this is the last 12 months, like May 2024 to April 2025. So if you look at May 2024, they made 1.4% premium. They distributed 0.70, which is like half of it. So usually they will distribute half of the premium earned. However, they will distribute only maximum 1%. So it would be half of the premium earned or 1%, whichever is less. That's the policy. I'll explain to you in the next slide, but if you look at this, you will understand that 1.5% in July and 0.77% they distribute. And similarly, if you go all the way to December, December is a unique month, 2.43% premium earned, and distribution is slightly higher, 2.84. So December is the only exception where they distribute more because they will distribute all the accumulated earnings or premium earned over the period of 11 months, and then they will pay it off in December because at the end of the year fund is supposed to pay all the premiums earned to its shareholders. So that is why they pay you those high distributions. And in technical terms or tax or accounting terms, they call it return of capital. That's a big topic. It's beyond the scope of this session. So most of the funds will actually calculate at the end of the year what would be the return of capital. Like some assets might have appreciated, there would be some extra premiums in the fund. They would pay that as a return of capital to the unit holders. So that's how it works. And if you look at the last 4 months, January, February, March, April, it's been more or less like 1 point around 1.8%, 2%, 3%. In March and April, it's very exceptional. Like you see 2% premium earned, and April is 3.5%, pretty high, pretty high. And they can distribute only 1%, like because that's the ceiling they have. So which means that the remaining earned premium is actually staying in the fund, which is building up the stability of the NAV and also provides option to write more calls in the future. So that's something which is interesting. We have to see how this is going to help in the future for XYLD. So we have seen the XYLD side of the story now. Now coming to the XYLG, which is the growth fund, you have a similar concept with the XYLG. They distribute half of the premium earned. Like in this case, they earned about 70.7%, and 0.34 is distributed. Similarly, June they earned 0.68%, half of it distributed, and so on and so forth. So they've been doing only half of the premium which are being distributed to the unit holders. The only exception is December, where they made about 1.21%. However, the distribution is 18.81%, which is very, very high for this type of fund. That could be due to the capital appreciation that they have accumulated in the last 12 months from the appreciation of the assets or holdings. So that's the kind of a big bonus that you're getting in the form of distributions. So even though it's a distribution, it's technically not the just the premium earned. It's also due to the appreciation of the holdings and appreciation of the net asset value of the fund. The various factors which go into this one. If anybody who works in the fund industry or you know more about this, um, capital, return of capital or distribution at the end of the year, please drop in your comments or feedback. I like to hear that. But based on my understanding, I think it is due to the appreciation of the underlying holdings. Stock prices have gone up, underlying holdings went up, so the net asset value of the fund goes up. So obviously, that also had to be distributed to the shareholders. Similarly, extra premiums earned, or sometimes the calls get assigned and you get capital gains on the premiums in case of calls getting assigned when you write calls. So that could also be a factor. So all that is adding up to that 18.8%. And when you look at January, February, March, April, obviously April has been an exceptional month, 1.74% premium earned. March has also been a very high month compared to the previous months. And you can see the distribution has gone up to 0.89% in April. And even for this fund, the maximum ceiling is 1% distribution. So I hope that when they do this in the future, assuming the volatility goes up, premium goes up, I think there would be a time when the XYLG's distribution also hits the 1% ceiling, and which means that once it hits that 1% ceiling, they cannot distribute more than 1%, which means they have to retain the excess earnings in the fund. Excess earnings can be used to reinvest back into the fund, into more holdings, and if they increase the amount of holding, they're going to write more calls, and that is going to generate more income. Plus, also more capital appreciation because in the growth fund, you have capital appreciation, which is half of the portfolio. Just remember that half is, you know, growth and half is basically covered calls. So you get the benefit of limited upside and more income with the covered call part of it. Plus, also you have the unlimited upside with the growth part of the fund, which has no cap. So you get the best of both worlds. So that gives you an idea of the difference between the two funds. Okay, this is what I wanted to share with you. Anybody who is investing in global X funds, especially these XYLD, XYLG, or QYLD, QYLG, and similarly for the Russell 2000, RYLG, RYLD, you need to know this part of it, which is very important. How much they distribute and why the year-end hike, dividend hike. Okay, so these two things. One is the distributions are approximately capped at lower of half of the premiums received or 1% of the net asset value. As I explained in the previous slide, they distribute 50% of the premium. However, if the premiums are more, like let's say it's more than 2%, let's say it's around 3%. So technically they have to distribute half, which is 1.5%. But when it is 1.5%, they will distribute only 1%. So the remaining 0.5 will remain in the fund. So the excess amount of option premium received will be reinvested into the fund. So this is what the policy of Global X ETF says. You can go to the website and check out the full details. And I don't have any opinion on this. The only opinion I have is like they are able to retain some funds, some excess, earnings, and reinvest back to the fund, which is positive in a way. But it has its own pros and cons. Like some funds distribute all the premiums earned, and you as an investor has the freedom to choose However, you're not investing in just the Global X, you have other funds too. So always choose a mix of funds. Don't go just to one fund house and pick every index ETF from Global X. I am not recommending that option at all. You need to pick good funds from Global X, probably good funds from Neos, various other providers. Like, I'm just giving you examples. This is not a financial advice. And second point is year-end distributions can exceed the general guideline due to the capital gains that are paid out end of the year. So that could be the reason why the December, distributions are pretty high, and that's why the yield for XYLG is so high because they have accumulated a lot of gains and a lot of capital appreciation, which has to be distributed because the fund operates in that way. Okay, let me move to the next area, which is pretty interesting, and this is a debatable topic: who performs well? Okay, at the end of the day, which fund will perform well? I wish I had a crystal ball, but I don't know. But so far in the last 1 year, I see that XYLG, the growth fund, performs well. Uh, I'm thinking, or I'm guessing that XYLG will actually beat XYLD in the future. The growth fund will beat the, the dividend fund in the future. That's my assumption, but I could be totally wrong because we never know how the future is going to pan out. So XYLG will beat XYLD. This is just my own, analysis. Take it or leave it. It's you can have your own, opinion on that. And given the steady upward moving markets due to the 50% call rate, because once the market start moving up and volatility goes down, the dividend and the so when there's a lower volatility, the covered call funds will earn lesser amount of premiums. Premiums are not going to be that rich enough. So obviously the earnings come down. When the earnings come down, the distributions come down. So it has that domino effect as the markets start moving up and become less volatile. And XYLD dividend fund can underperform in steady bull runs. So we are seeing that bull run coming back, because of the change of policies and change of stance of the US government. But we never know what's going to happen probably later part of the year. Now, till summer, things look promising. But once we get to the late summer and probably early fall, like we never know how the markets are going to go up or down or what's going to happen. The underlying assets in XYLD, they are written at the money, meaning they are written at the current market level, which means there is no scope for upside beyond the current level. The fund is actually writing entire portfolio at the current market level and harvesting or reaping all the dividends or the premium income. So when you write a call, you earn all the premium income, and that enables the fund to pay all the dividends. There's no scope for capital appreciation. That's the biggest worry here, leaving no scope for capital appreciation. Um, if the markets turn back in the reverse direction and go down, or if it becomes too volatile and then suddenly there is a fall and becomes choppy and then suddenly flat again, it falls and then flat and goes up a little bit. In bear markets or flat markets or choppy markets, let's call it that way, XYLD will outperform. And XYLG, the growth fund, that is also going to do well in that environment because 50% of the portfolio is again similar to the XYLD, but they may lose a little bit of the value, you know. And I see it as a good opportunity because if you are a long-term investor, if your fund value comes down and you have the growth component within that fund, when it comes down and when it's available cheap, would you not like to buy it? Like, you know, all the gurus talk about, buy low, sell high, and, uh, be greedy when the whole world is, um, fearful, or be fearful when the whole world is greedy. All that, great piece of advice you hear. But are you really doing that? Like, that's the thing. With XYLG, you are able to do that, in my opinion. Using the growth fund, XYLG, I am able to do that because I am not going to be so much worried about how much dividends I'm earning and how I will earn that dividend and put it in another fund and so on and so forth, because I'm not so much focused on the exact number and I'm not living off on the dividends. and this channel is not recommending that, and I am not recommending that option at all, unless you are someone who is retired or your situation permits that kind of a lifestyle or option. That's fine, but it's difficult to rely 100% on these kind of distributions, and you cannot rely on one fund. If you're even relying on this for income, you need to have a few more funds to help you grow as well as make that income. That's why I see that in XYLG there is an opportunity to buy at a lower price, especially when your markets are flat or choppy. You can do that with XYLD also. But in XYLD, you don't have the capital appreciation potential, which you have it in the growth fund. So in XYLG, in the growth fund, you benefit both ways. Like you're buying at a lower price, capital appreciation potential is there. Plus, you're also buying at a lower price and you're earning the same amount of dividends or higher dividends, which is higher yield. So you are benefiting both ways. And when you get that higher yield and you can invest in some other fund or some other stock, etc., that's a separate advantage that you have. That gives you more optionality to play a different type of game. Like so, A, you get the distributions, B, you get the capital appreciation, and C, when you are able to get the higher distributions, you can deploy it somewhere else. So you get that three different optionalities, and having those optionalities makes you stronger because in future you can have a diversified sources of income coming in. Sounds pretty interesting. That's how it works. Why pick XYLD then? Like since I said that the growth fund is good, why pick XYLD? Okay, so suppose you are an investor who has other stocks or other parts of the portfolio which are doing fine. You need more income on a regular basis. You don't care about your other portfolio or other things. So in that case, you are okay with the XYLD. Like you don't care about the price. As long as the dividend comes in, I can sleep well, I'm fine. And you have another source of income, let's say for your living expenses. You're not so much worried about the exact dollar amount that you're getting, but you're getting something every month. Fine. Go for XYLD. Second, the other parts of the portfolio, let's say you have other parts of the portfolio which are into growth. You have all the FANG stocks or the Teslas of the world in the other portfolio, which is doing well, and you want some steady income in addition to that, and you want to add XYLD to give you that stability or that extra income to stabilize things, then go for it. It's only a part of your portfolio, it's only one part of your overall strategy. Or third scenario is you need some income or cash flows in down or flat market situations. So you bought XYLD. And when the markets are up, I mean, doing well, you're not going to sell off XYLD. No, no. It doesn't work like that. You have XYLD in your portfolio to get that income or benefit during the flat or down markets. However, when the market goes up, you just leave it there. Because next time when the market comes down, your dividends are going to go up further. And when the market goes up, everything is fine. You might get XYLD pretty cheap. XYLD may go down and it can get cheaper. So you add a little more. This strategy is being implemented by some investors, and they have been pretty successful. Like, they don't get into XYLD all the time. Like selectively move into XYLD and then reap the benefits of it. It's just like this. Like you buy certain stocks in certain points of time when it is favorable. At other points of time, you just let it sit in the portfolio and let it earn the dividends, etc. So these are three different reasons why someone would pick XYLD. Uh, if you are holding XYLD or you purchased XYLD recently or in the past, let me know what are the reasons, what are the comments below. And I like to hear if you have any other ideas or reasons. So all in all, like it's all about someone who is needing that income on a regular basis, regardless of price appreciation. That's the kind of person who is investing in XYLD. Okay, move on to the next one. Why pick XYLG, the other fund? Okay, in this case, you want that regular income, like the previous case, but you also want to have that capital appreciation potential. Why that capital appreciation potential? Because you want to, have a stable capital appreciation, or you want to reinvest when the fund is priced low, so that you can get the difference in price. Like you buy low, you know, and probably you can sell high, that kind of thing. Or you want an opportunity where you can buy assets cheap, and in bull markets probably they get more expensive, and you can probably sell or you can hold assets at a higher value, like you want to grow your assets. That's the first point, mix of income and capital appreciation, and the opportunity to buy low and benefit over the long run. The same thing that I explained. But in this case, you are looking at the long run. It's not like you're going to buy it today and then next month you're going to sell it off, or you have the idea that I'm going to accumulate a lot this month, and after a couple of months I'm going to just you know sell off and offload everything. That's a great strategy, but it may not work. Like trading XYLG may not be a great strategy. So I'm not recommending any kind of trading or anything like that. You have to hold it for the long run. So in the long run, even if you go wrong, you're not holding any penny stock. You're holding the S&P 500. So remember that you're going to go come back anyway. Like you're not out of the game anyway. So if you want to hold any penny stock and bet on it, sometimes it works, sometimes it doesn't work. Even if you hold four penny stocks, one of them hits the home run, you're successful. That strategy sounds interesting, but what if one of them hits the home run, but the other three pull it down, and over a net you're making zero or you're making negative returns. So in all the four penny stocks, you're making negative returns. In that case, you lost the game. You lost the capital. You wasted time, you wasted all your energy, and after a couple of years, you're back to square one. You have to start all over again. In this case, even if you lost some money, etc., etc., give it a little bit of time, give it a little bit of time to recover, plus earn the dividends, enjoy that. Over time, things will be fine. Or you can even buy little more and add more at a lower cost. So the idea of eroding capital with high yield is okay, but you need to see capital appreciation over the long term or stabilize over the long term. So in this fund, there is a risk that I highlighted here. Here, there is a high chance of capital eroding. As I said, like the capital eroded, like I gave you the example, 10.7% loss in capital. That's something you need to be comfortable with. If you're comfortable with that kind of volatility, then XYLG is a good option. And you can stabilize and see capital appreciation over time. So all in all, what I prefer is personally, I would go with XYLG. I have it in one of my portfolios because I like to see that growth happening over the long term. Because if the value appreciates over the long term, I don't really have to worry about whether I have to sell it or hold it, etc. And I don't want to be under the pressure of buying the fund when it falls in price. If XYLG falls in price, I have the savings. I'm going to be happy buying it for the long run. If I'm not able to buy it, I just let it stay there. I just let it grow. Like I don't have to worry about selling or what is the return and all that, because I know that 50% of the fund is already giving me that income. The other 50% is giving me the growth. So I get the best of both worlds. And XYLG is more closer to the S&P 500 returns because it's closely tracking the index. And XYLD, which is a dividend one, it has a little bit of a lag. So that's the difference between these two funds. You can make your own choice. Both funds are good enough. And in both cases, some of the points which I mentioned for XYLG are good for the other fund, except the part that it doesn't have the capital appreciation potential. So, depending on what type of investor you are or what you're looking for, you can pick either of them, and each one has its pros and cons. I hope you like this video and I hope you enjoyed it. And if you want to know more or if you want to have any conversation or comments, please drop in your comments or feedback at the bottom. And I look forward to hearing from you. Have a great day. Happy investing.